Okay, guys, and it appears we are now live. So, welcome to the Fairground Jam. We host this every Thursday at 6 p.m. BST. We talk about things to do with Fairground, and we also often interview members of our team. Today, we're actually doing both, and we have Dawn and Witold with us. So, Witold's from research, and Dawn's in the community team. Now, they're both very active on Discord, so you've probably seen them before. But in the Fairground Jam, you get to see their faces too, which is exciting. And we have been running the LP incentive this week, and as I'm sure you guys know. And so they are going to give us a bit more detail about what's been going on, about updates, and also answer some of your burning questions that we've been helping people a lot in Discord. And hopefully we can continue that here on the Fairground Jam. And so with that being said, Dawn, do you want to kick us off?
Let's go for it. And thank you for saying that seeing my face would be interesting. But yeah. Let's start with, I just want to say thank you all, because I've realized that this is not the most simple incentive we run. And so we definitely understand this. And I mean, both technically and how it works is something that's kind of difficult to get your head around, right? So honestly, I really mean this. For the ones that have successfully committed liquidity, I'm actually impressed and really great job. Because again, this was not simple at all. So I hope you really learned something. I hope you could enjoy it as well, even though it was a bit of a struggle, because we've enjoyed it a lot actually, and we got a lot out of it. So I'm going to start off with some questions I've received and some comments has been in Discord during this week. And to start off with and kind of try to give an explanation or give an idea what we're going to do in the future. First of all, the registration process. With that, I mean, the linking to the Twitter has not been as smooth as we would like. And so we understand that's been quite like irritating at sometimes, honestly, with a copy and paste, but we will definitely work on improving that. When it comes to the hosted wallets, because that's been something that's been a question as well, because people want to run Gitpod. And for the ones that registered their address before, when we had the option of actually doing this, they were able to run the Gitpod. But since this functionality is not active anymore, it's not been possible. So we understand that this also has created some issues, and people, well, we're glad that you have actually downloaded our desktop wallet and got to experience that. But we also understand that this has been a new experience for a lot of people. But we are working on making the next incentive that's linked to this to make it simpler and easier to do. But still, we're very happy that so many people managed that work with the desktop wallet and both the CLI and the desktop. So again, good job. When it comes to the faucet, you might have noticed that's been some interesting numbers on the leaderboard. It's like a lot of questions about that, and even people even contacted me and said like, what's actually wrong and how you could actually abuse it, which I appreciate as well. Like honesty is always appreciated, and so know that we take note of that. So the one to reach out for me regarding that, we know who you are and we really appreciate it. So what I can mention about regarding that is, if you look at the incentive and what it says that it's based on the P&L. So that's what it's based on, right? So we're going to do calculation for that as well. So don't be too worried about. I know the leaderboard has looked a bit funky, and I know people got a bit stressed about that. So yeah, no, we are aware, and we will look into that and we will handle that. And we looked in, of course, I got some questions as well, because there was a little bit of a price spike. We'll go into the details to that a bit later, or quite soon. So there was quite a few that was a bit surprised and said like, why am I at 0? So basically, you got liquidated. I've experienced that in not a testnet, and I mean, yeah, that's the worst experience in this. I mean, I guess you got to learn something, right? You got to learn how the risk and what happens when well, you put too high risk positions, or maybe, I mean, as for me as well, when I put submitted liquidity, I mean, if you commit too much, what can happen if you're not careful? So yeah, it's an experience, but still, as we run, we set the leaderboard, and it's, well, we see the P&L and it's top 150, and that's still it. So even if you had 0, I mean, I guess now I don't know how many there are on the leaderboard. Is it 138 maybe? I think last I checked. So, I mean, it still means that you're on the leaderboard, and just to be fair, like to be clear, like we're doing this to test our system, right? We're not doing this to, I mean, to push you to go high in the leaderboard is to make it a bit of a competition, right? To make it interesting, to make people really think about strategies, and that's, I mean, it's a good thing, but it is about testing our system. It's about pushing it. So yeah, it's still, if it's 150 or 100, if it's 135 or 140 on tomorrow when it's over and you're at 0, it's still you. If you're on the top 150, it's still how it goes. And that, I mean, with the P&L. And again, faucet is a different thing, right? So some of the questions we received before this price spike is that people put liquidity, they pushed it, you could see that it worked. Well, there's been 2 things basically. So people say that I pushed the liquidity, it looks like it's fine. I mean, it pushed through, they got no error, no anomalies, and then they couldn't see themselves on the leaderboard. Well, just a heads up is that make sure you put the correct market ID. And the market ID is not Sol USD. The market ID is in the description on the console. Okay, so don't put Sol USD because that's not the market ID. So, and then we got the question again. I get back to it now. So, why were they liquidated? So we're going to answer like how liquidity works and how this whole incentive works. We're lucky enough to again have Vital there. He's our savior as always on these events. So maybe you could give us an insight on how how it works when they commit their assets, and I mean how the fees work and how the liquidity actually works for the buyers and sellers.
Cool. Yeah. So I'll maybe give a somewhat waffly answer on the whole mechanism and so on, and then if there's anything I don't cover that you had in mind, then let me know. Not much of a savior. I've not been to a Fairground jam in a while, but thanks anyway. That's very kind. Okay, so let's maybe start somewhere. So why exchanges need liquidity? Well, Vega is not an exchange, but it's a protocol where people run markets. So, you know, to some extent, it has needs similar to exchanges. So every exchange kind of wants liquidity in a sense that it's not much of a trading venue if there isn't any liquidity. So like if you had a market for corn in a village, but someone would, you know, come to buy some corn and no one's there, and then someone would come to sell, but then there's no buyers, then that's a crappy market. So we kind of want someone that is always there at the stall and is happy to either buy or sell, takes, you know, makes a bit of money on that. So, and it's not that different in sort of, you know, stock markets or whatever, electronic markets. So you need those people, you need to incentivize them somehow. In traditional exchanges, it usually takes form of some bespoke legal agreements that have some clauses. They may be, you know, they are definitely expensive to construct. They can be expensive to enforce. You may not always be able to enforce them. So all of that is not that great. It means, you know, to run any new market, you need basically a lot of money and a lot of time to be able to go through that pain. So it kind of raises barriers to entry. Not every market kind of happens because of that. Every venue wants liquidity because it, you know, provides for better trading experience. Basically, there's less slippage on any order. but less slippage, meaning that if you want to trade something relatively big, if the slippage is low, you can hope that the average price of the trade is not going to, diverge that much from the current sort of market price. Could be a mid price or whatever. With derivatives exchanges, it gets a bit more complicated. Not necessarily complicated, but liquidity is even more important in the sense that it's not only a nice to have feature that those venues are after. It's kind of critical to have it. It's because those derivatives are traded on a margin. That means in order to open a trade, you only need to deposit some portion of the value of the trade. The value of the trade itself is kind of an estimate to some extent, because some of those things have unlimited upside or downside. And then there's this thing called the margin call, right? So in most traditional exchanges, it happens once a day. At Vega, it happens on every price move because it's just simple enough to do it. And it means that we check, how the market is looking. From that, we derive the margin requirement for everyone's positions. We check their balances in margin accounts. If those balances are not enough, we try to allocate more money from the general account. If that cannot happen, then they get closed out, which means we forcibly enter into an opposite side. So if they are long 5 on some futures market, we'll go short 5 sort of on their behalf. But there's nothing that they can do. The network just does it on their own. And it offloads that position to someone else that was on the market and then was offering that volume. And that person is then better capitalized, because in order to open a new trade, you need to meet at least the initial margin requirement, and it sort of carries on like that. But it just means that liquidity is crucial in a sense that without it, we cannot close out those undercapitalized parties, and that means basically accruing risk in a system, because the market can keep moving against them, and eventually they will run out of money. So they won't be able to meet the mark-to-market. So the margin calls, not the margin calls actually, but the mark-to-market payments. So they'll be making losses on those positions. And on every market move, we kind of do the accounting in the sense that whoever gained makes a little bit of money, whoever lost loses a bit of money. And obviously, sort of one side needs to equal the other. Otherwise, there's a problem, right? There's different sort of things that we have in place to safeguard against even those scenarios. But having enough liquidity is kind of crucial. So I guess that maybe hopefully gives the motivation. Now a bit about mechanism itself, maybe, that we have at Vega. So obviously, Vega is all about permissionless market creation. Everything has to be embedded in the rules of the protocol. They are kind of non-negotiable, transparent, and same for everyone. It's because Vega is meant to be a protocol that results in a network, but there's no operator, there's no legal team and whatnot that will be able to look at everyone's willingness to, let's say, become a liquidity provider and somehow assess that and write down a contract and all of that. That just cannot happen. It would be pointless, right? But it's also important to do it in some way, because it's nice to talk about permissionless market creation, and it is nice. It is a great idea, but without liquidity, it's kind of moot point in some sense, because so what that anyone can propose a market, and maybe people think it is a useful market and they voted in, but if there's no liquidity, then, like we talked about the village and the corn market, it just isn't a useful market, and it eventually just dies out, right? So in order to solve that problem, we've come up with all those that whole liquidity mechanism and then the incentives it has built in. It kind of has to work both ways, right? So it has to provide enough liquidity for markets to operate. That liquidity needs to be solid in a sense that it cannot disappear, at different points in time. That actually happens quite a bit in traditional markets, because those legal agreements that either venues or maybe even the stock issuers themselves, because they are also sometimes interested in hiring a market maker, those rules would say something like, they have to be present on the order book with some, number of orders or whatever, some volume, let's say 80% of the time, right? And what happens is what always happens. So you always get what you pay for, in a sense. So those market makers are by no means evil or anything. But they are quite close to, if you ever read an economics textbook, there's always this notion of a rational agent. It's actually quite difficult to find them in real life because people have emotions and whatnot. But those guys are, I would say, quite close to rational agents. So what they would often do is they would try to meet that 80%, let's say 80%, right? It depends on markets and stuff. Would try to meet that criteria when it's kind of plain sailing. There's not that much going on in the market. It's, quite easy to sort of be balanced, not accrue too much of an inventory, either on the long or the short side. And when things start getting tricky, like they, see big orders coming in, increase in volatility, they would maybe pull out for a bit and just kind of see what happens, and then maybe wait for the market to move to the new regime. And, that would be catastrophic in the case that I've described for derivatives markets, because that is exactly when we need that liquidity even more than in other sort of occasions, because that is when we will likely need to close some people out and so on. So the way it's solved, okay, sorry, I was talking about sort of motivations. On the other side, you need to give those people enough of an incentive, right? Because if you're asking them to do something fairly tricky, as all our participants have seen, I'm sure, sort of outside Fairground Jam, it gets even more tricky, because it's not just only about sort of managing to integrate yourself with Vega and the APIs and manage your positions and your liquidity provision, but you also need to somehow manage those orders, right? So you need to either, be quite active about your inventory controls. Like I said, you don't want to amass too much, because then whenever there is a market move, you could make a big loss. I mean, you could also make a gain if you're kind of lucky, but more often than not, you'd be making a loss, because, people would be selling a lot, you'd be buying all of that because you kind of have to, and then the market would be moving down. So what they often do is they would hedge those positions. So they would enter into different trades, either, could be other markets on Vega, could be other markets in general, like some of them even traditional markets, which, by the way, is kind of why it probably isn't such a, because with Vega, everything's transparent. Like, you could see who is a liquidity provider through the API call. You could see what their orders are, and you're like, okay, I guess this guy has a, huge trading team, a lot of in-house talent, then it knows what he's doing. So I'll just copy it, right? Not a bad idea, I guess, in general. The problem here is that you don't see everything that they are doing, right? So they could be entering in a bunch of different trades in different venues, so that they are as close to market neutral as possible. And again, you'd be kind of, I guess, okay most of the time when the market is kind of well behaved, but when there's some more extreme event, then you likely get wiped out, because you just don't know what they did to sort of insure themselves, right? Sorry, but I'm going on a tangent, I guess. But it is a difficult thing that we ask them to do, right? So we need to incentivize them, because they are not, Santa Claus. They don't do it out of the goodness of their hearts, obviously. There needs to be something in it for them. So they do get a claim on portion of the fees. So that's motivation. And now maybe let's go into a little bit of more detail. So as everyone who's taken part in incentive would know, in order to become a liquidity provider, you need to submit a liquidity provision transaction and specify a bunch of things. One of them is your stake. That is the amount of funds in the settlement currency of the asset that you need to deposit, and it gets locked away. You don't have access to it.
Is that the commitment you're referring to, right?
Yeah.
Yeah. Okay.
Yeah. Sorry. I guess maybe different internal naming.
Yeah.
I'm not.
It's because in the code we...
Yeah, no, but that's a good call. So whenever I see something silly like that, please do correct me. And yeah, you can only reclaim that money after you cease to be a market maker, a liquidity provider. Why we have that? That is because we, again, need that liquidity to be firm. So we cannot have people run away, but we also need them to be a bit better capitalized than your regular trader Joe that is in the market. So they are subject to, so that commitment then translates into how much liquidity they need to provide on the book. So how many orders basically they need to do. It's not as simple as how many orders, because those orders are probability of, so we have this concept of probability of trading, right? So every market has a risk model underpinning it. That model is basically a stochastic differential equation. All that means is it can give you a distribution, a theoretical distribution of prices in the market at sort of any future point in time. So we use that to back out the probability of trading at any of the price levels. It's, how sort of reliable that probability is depends on how well the model was calibrated, also how the market behaves. But there is a lot of sort of rigor in deriving those things, but it's maybe important not to get too hang out on them. So like all that is, the most important thing is that it gives us a bit of a gradient. So that probability of trading is decaying as you're moving away from the min, right? And that is to discourage people from, or not necessarily discourage, but to give them like some sort of a currency. Like, yes, you can move further away from the mid. That usually means that you're going to be trading a bit less. So you're going to have to, like, your inventory control is not going to have to be as strict, because oftentimes you're not going to be amassing, big positions. But if you want to do that, then you need to provide disproportionately more liquidity than someone that is very close to the action, right next to the best bid and ask, let's say. So they, as a sort of reward, get away with posting much less orders. And that is, again, to, sort of have clear rules that make sense for everyone and avoid those situations where, again, that's, been seen in traditional markets where market makers are kind of there, but not really, because they are, just hanging around in the corner and hoping they won't have to talk to anyone at the party, basically. So they are kind of there because you told them to come there, but they try to, just stay away from the action, because the action means problems. And if they get paid, a fixed fee, let's say, or some portion of the overall trading, they don't really care if they trade or not. So that's why we have that. We have this notion of markets liquidity demand. It's sort of estimated from markets open interest, but let's not go into too much detail. But so we have a way of estimating market liquidity demand, and we want the liquidity providers to either meet or exceed that demand. So when they submit those liquidity provision transactions, they also submit their liquidity fee bid. I will maybe talk about the fee components in a minute. But what we then do is we sort all those transactions in the ascending fee order. So whoever proposed the lowest fee is kind of first, and then if you imagine that table that is sort of sorted in the fee size, we then look at a different column, so the liquidity commitment, and we just keep summing it up until we hit or exceed the figure that we have for markets liquidity demand, and then we look back to the fee column, and whatever fee is at that row, that is the fee that we're charging for liquidity for all the trades in the market, and also all the that fee then goes into a bucket that gets distributed among liquidity providers once per epoch, I believe. Again, proportionally to size of their commitment, and also the ratio of current market value estimate to when they joined. Again, that is the sort of quirk of the mechanism that is there to incentivize people to join early markets, or not necessarily early, but markets with sort of low valuation. Those would usually be low early markets, but also, could be markets that are going through some, let's say, tough times or whatever. And again, in those times, we value any liquidity that wants to, come into the market much more than in times of, let's say, prosperity, when there's, a lot of trading, a lot of organic liquidity, not even coming from liquidity providers, but just people posting orders on a book. So that's that.
So just comment. So we can see as from a like a buyer or seller's point of view, if not the liquidity providers, how this affects them is, as you said, that when you buy or sell something, you will first pick the liquidity provider that provides the lowest fee. Basically, that's where you start, right? And then you
no. So the fee is the fee changes with that liquidity demand and sort of the liquidity commitments, but then everyone has, like, all the liquidity providers implicitly agree to the same fee level. So those who propose the lower fee get kind of pleasantly surprised, and the fee ends up being more than they wanted. Maybe not pleasantly, right? Because they don't always. It's not always like the highest fee is the best. They try to maximize the sort of yield from trading. So if you have huge volumes, you can get away with low fees and make the same back. And conversely, like if you crank up fees too high, you're gonna eventually depress the trading volume because people just wouldn't want to trade at such a high price. So it is a balancing act. But the idea is that they will be able to sort of crowd sources in a sensible way. So people will undercut each other because they will think that is a sensible fee, and will use whatever sort of clears the market. You can cease to be you can withdraw your liquidity provision whenever there is more liquidity committed to the market than its demand. So that means, because we talked that those guys kind of before the level that gets chosen, they get pleasantly surprised, let's say. The other guys, they have to suck it up and agree to a lower fee than they've proposed, and they may not like it because maybe their business model doesn't allow them to trade at such a low fee. It then becomes not profitable, not worthwhile, whatever. But because you can pull out at any point when there is more liquidity than it's needed, then they are free to leave, and that's fine, right?
So what could happen, for example, if you look at the incentive now? So let's say that it's a low liquidity market, and we enter in, the fee is calculated to a certain percent, and then someone contributes a lot of liquidity and offers a really low fee. Then the average fee, it's gonna be a difference for the ones that are in the market, because then they're gonna shift the fee, right? So it's like there's three people contributing to the market now. They put their liquidity provision transaction, and they put their fee to, I don't know, 10%. Let's say they go there, right? That's what they do. And then it's going to be that. But then it's going to be another person that contributes a lot, and he pushes like 3% fee. How would that affect? Like, what would happen then?
So you can only affect the market as long as in the range where it's below the supply, the liquidity demand, right?
Okay. Yeah.
If the demand is already met, I can supply 100 times the current liquidity and ask for an outrageous fee, but I'm going to be at the very end of that list, so I will still be in that market, but I won't be able to dictate that price. So you can only do that when there is not enough liquidity in the market, in a sense.
Okay. As you can see, I'm not an expert in this either. This is why we have Whittle here, because this is something that's, to me, well, it's extremely interesting, but it's something new from people that's been the traders kind of point of view, and now for the liquidity is something that's I find very complicated. So as you can see, so that's why when I ask questions, they might be sounding like, it doesn't get every detail. Like, it's the same for you. Like, just ask questions. Like, we're all here to get better from people like Whittle.
Yeah, no, and those are good questions. I've been kind of involved in designing this mechanism and implementing it to some extent, and testing and whatnot. So I've gotten kind of intimately familiar with it. So I'm happy to talk about any bit of it. But that's only because I've spent so much time on it. It is complicated, like there's no denying that. It is potentially overcomplicated. I don't think so, in the sense that we've given ourselves as many sort of degrees of freedom that we needed to sort of test drive this idea. But there may be, it's kind of ongoing research to some extent. We may be able to simplify it a little bit, because one thing that I find a bit, I wouldn't say counterintuitive, but it's just difficult to get some intuition for it, is how the liquidity commitment translates to the number of orders I actually need to deploy, let's say, at the best bid and ask, to sort of get from the whole probability of trading and stuff that complicates it even further. And currently it's a network parameter that does the scaling, but that it's kind of a multiplicative factor. So it's a bit difficult to interpret that. So to me, like, if we could in the future maybe change it to something like so that people could think about it in terms of leverage at some standardized price level, let's say they're providing most competitive pricing, again, to just get rid of that whole probability of trading. That would be then, I think, easier to reason about, because it's easy to derive the maximum leverage for the market. That's just 1 over the maximum risk factor. So then you could see, how much lower is the leverage that we allow liquidity providers to take. And I think that is a more sort of intuitive way to reason about, because it gives you something tangible. You're like, okay, so maybe normal trader in that market can go 100x, but because we want liquidity providers to be better capitalized, then they can only go 5x or whatever. I'm obviously making those numbers as I go along, but you know what I mean. Yeah.
Well,
so we have a follow-up question in the chat about this, and so the question is from Nelson, and he's asking, so he wants more clarification on when you can kind of dictate the fee in a market. So is it when you're an early provider, or do you mean the only provider that enables you to kind of dictate the fee in the way that you were saying before, we're told?
You can only dictate the price when there's not much liquidity in the market, basically. I mean, you can always dictate the price in terms of depressing it, because you can always undercut everyone. And then, if you imagine that sorting, you're jumping ahead. So you're basically always dictating the price to some extent, like influencing it at least, when your fees are so competitive that they get you, in that region of this table that is kind of below the market's liquidity demand. The extent to which you dictate that depends on your stake, right? On your commitment. So if the commitment is also big, then yes, you are effectively dictating the price. If the commitment is tiny, then yeah, you do influence it, but to a fairly small degree. Yeah. But it's kind of not possible if the market is already well functioning and kind of oversupplied in liquidity. There's no way that someone can, sort of take over the market just because they have the deep pockets. Again, they can do it, but only in a way that is positive for the market, because they would be kind of effectively lowering the fees, but they can never increase them, because if we don't need that liquidity that badly, then we don't care. Like, we're still happy to keep it, but you have to agree to the price that the market clears at, and that's it.
Yeah, I mean, I find this extremely interesting, and I'm sure a lot of you listening as well. So go further along. As mentioned before, we saw a big price jump, or price spike, I guess we should say. Price jump instead of that, price spike. Could you give us some more insight on I mean, we know now why this happened, but what happened and why it's important that it works like it works?
Yeah, okay. So price spike itself is a artifact of the limit order book market, right? It just means there was a huge volume that came in, and it kind of consumed the book so much that it drilled into either buy or sell side so deeply that it moved it to a completely different region. That can happen in any market. It can happen because there genuinely was someone that was a whale, and not only a whale, but a whale in a hurry, and they wanted to do it quickly because whatever, they needed to buy a new Lambo or whatever. It could be that high frequency trading prop firms had their bots kind of enter a weird feedback loop with each other and move the market to a weird region for a moment and then kind of corrected it again because then they saw a bargain and they went the other way. Flash crash basically, and there's been many flash crashes in different markets. So it's kind of, and that's sort of fine. I mean, it's not great. The problem with that is it then isn't really a genuine price move if it kind of goes up and down quickly, right? So there's not, but what it does a lot of damage in a sense that some people temporarily make a huge gain that they'll have to then pay back anyway, because then they'll make a big loss relative to that, elevated position. But others will, make a loss to begin with, potentially to the point of, getting under collateralized, closed out, making a huge loss. Whereas if we kind of, said that let's pretend this never happened, the net effect would be marginal, right? Obviously, that's not how markets work because we cannot ex post decide that. I mean, that's not how they should work. How they work is complicated, and I don't have that much knowledge on it actually, but well, you can read about it. The different markets and so on, that they do sometimes, eventually suspend trading, people get into a room, make deals, whatnot, but yeah, we're not here to talk about that. But what that shows us is that there's some value in being able to sort of distinguish between the two cases, right? Because sometimes it is you often see those sort of regime changes that market, quite often on opening, maybe after a weekend or whatever, that the market made a huge move, and that move was kind of permanent. Then it trades at that level for the next week, month, year, whatever, and that's fine because there was maybe new information in the market, and that is now the new sort of sensible price. But you could also see this kind of spike, and you can only know after the fact, right? Usually. So what we do at Vega. As I mentioned, every market is underpinned by this risk model that gives you a probability of a distribution of prices at any point in time. So it's quite easy to use that to get a theoretical bands on what sensible minimum and maximum price is, right? Because the price will kind of go somewhere, and we know that if the price is that, we can feed it to the risk model and we can give it some horizon, like over the next hour, price now is 100, over the next hour according to the model and you specify the probability level you're interested in, maybe 95% probability, the prices should stay within 100 and 10 and 85 or whatever. Why not? Depends on the model, right? They give you different shapes of distribution. It doesn't have to be symmetric or anything like that. And then maybe the market trades in those bounds because the model sort of was sensible in that case, and it worked. I mean, the model can be sensible even if you breach those bounds because it's just probabilistic, right? Maybe we ended up in that 5% case where we do exceed it. And if that happens, then we temporarily suspend trading. The order that would put it below out with those bounds, so either too high or too low, doesn't get processed in continuous mode. And then we've got this notion of persistent and non-persistent orders. A persistent order is the order that works both in continuous trading mode and also auction trading mode. A non-persistent one is one that only works in continuous trading. If the order is non-persistent and it would breach the bounds, it just gets rejected. That is because if we didn't have that, people could basically spam the market. They could submit an order that they know won't trade because they don't agree for it to enter the auction. And if we hit those bounds, then the only way trading can happen for a bit is in the auction mode. They could do it fairly cheaply. They would only have to pay the margin it costs to post that order, but they would have a huge influence, right? So that doesn't sound great. So in those cases, we just like, okay, so reject, nothing happened, market carries on. If it is a persistent order, so they kind of put their money where their mouth is, and they do agree that there is a chance that then it goes into auction. Let's pause and talk about what auctions are. So when you have a limit order book, right, you have orders on buy side, sell side, And then you have orders coming to the market, and they are either such that they don't cross those two regions. So there's more buy orders that are kind of here, and they get stacked, according to wherever they get, what their price level was. Same on the other side, but you could get an order that crosses, and then it gets matched with something that was on the book. We remove whatever sat on the book, we generate a trade, and we carry on. The only thing that changes in auction mode is that we can place those orders anywhere, possibly in this crossed state, right? Where the buy orders and sell orders overlap. We just don't do anything, we just observe. And people can still, amend those orders, sold them, create new ones or whatever. And at some point, there's some criteria that calls for the end of auction. Depending on the type of auction, it can be time-based, which is the case with this price monitoring that we're talking about now. So every one of those triggers has an auction extension, right? And you can have many triggers. You specify the horizon, so how forward-looking kind of they are, the probability level, so that affects the width of those bounds, and also the auction extension. You can have more than one, and you can breach more than one, and then they just sum up, right? So that is kind of to distinguish, have like shorter auctions for breaches that are not as severe, and longer auctions for something that really just goes, some crazy levels. It is because kind of the longer the auction, the more information we can gather from the market without doing anything, because those orders will be kind of stacking up, changing. So, people will be reading news, looking at other markets, whatever, trying to figure out what's going on, what the sensible price is. And then when the time elapses, we see how the order book looks, and we generate the trades. They all trade at the same price, and the price is chosen so that we maximize the volume. So we want to trade as much as possible, because market's been suspended for a while, depending on the trigger. So people have their needs. They have portfolios they need to rebalance, things they need to buy and sell and whatnot. So the more we can trade, the kind of better. Also, it is a sort of a way of choosing a sensible price for that option to clear, right? If many people want to trade at some price, then there's a higher chance that it indeed is a sensible price. So and that's kind of it. Yeah. So we're because one thing that people sometimes raise, and I do agree that you can think that way, is that we're somehow, because model is just a mathematical tool that is set up in some way, but it's theoretical, right? It doesn't know about this particular market on that particular day, why things go the way they go. But the model doesn't really dictate the market, in the sense that the market is still free to go wherever it wants if those orders stay in those auctions. It's just a temporary cooling off period in a way. So we are not sort of manipulating the market. I mean, we are to some extent, because if you don't trade for an hour, then obviously you don't see everything that would have possibly happened. But it's still all based on people's interest, supply and demand, and eventually it clears and it goes back into continuous trading.
So put in a simple way, like what we do, they happened today. I think it probably happened twice. I was not there to check. The market was put in suspend mode. I mean, it was suspended. Like, we call this a circuit breaker, right? Mm-hmm. When the price is very volatile and we set some limits, we say, like, if this happens within this time frame, it moves this much, we put it in auction mode. And we do this to make sure that we find the right price. So we kind of like put in auction mode, people can put buy orders and sell orders. And then we find the price where people in the market find, okay, this is the correct value of the asset, right? Just to make it safe, so we don't get this super high right away and then just super crash right away. So it kind of, it saves, could potentially, it's set there so it could save people from being liquidated. Like, that's the kind of circuit breaker. That's why I put the circuit breaker system. Yeah. Okay.
You can sort of think of it from a like information processing point of view, either in a very theoretical way, but even just intuitively. Like, if the market wants to move a little bit, it's probably fine. If it wants to make a huge move, it's kind of better to make sure. So to get more information from the market than one trade would give you, right? And that's all it is, really. And Vega team is pretty cool, but most of those things that we've been talking about today, the circuit breakers, the liquidity incentives, whatnot, those things did already exist to some extent, right? We are good, but we're not that good. We've not come up with everything from scratch. We've just kind of, we've protocolized the hell out of the stuff that's been going on in traditional markets for a while. Well, because that's the only way to have a protocol, right? You cannot have subjectivity. You cannot have someone that you call and then they say, suspend the market or not. It looks cool in the movies, I guess, or whatever. But that's no way to run a decentralized protocol. So you just cannot have that.
Okay. Oh, this is super interesting, and I mean, I'm happy that we got to see these things happening during this incentive, and people got to experience how they actually can function and what can happen. So I think, Sunny, do we have any other questions generally?
We do. We had one more question in the chat, which was about a liquidity crisis. So is there a mechanism or penalty in place to help with sudden liquidity crises if liquidity kind of dries up? How does the protocol deal with that?
Yeah, that's a very good question. And yeah, luckily there is. So when market is undersupplied in liquidity by a large margin, like we allow it to go slightly below, but if it drops too much, again, that's a network parameter. You might notice a pattern here. It is a bit of a cheap shot that whenever, we don't want to derive something, but we don't want to be subjective. It, for different markets, different levels make different sense. So, it's just a setting that can be modified via the governance actions in the protocol. When that happens, again, we go into the auction. We all know what the auction is. The only difference is that the price mentoring auction, it's still kind of like a random stopping time if anyone's into maths, because you could breach one trigger and have a extension of 60 minutes or whatever, or seconds, whatever. But then maybe when you try to get out of that auction, you actually breach all those other triggers that haven't been breached yet. So then you extend it even further. But at least you're operating on those chunks of time, right? So you're like, okay, so I can go and make a T because nothing's going to happen in this market for at least 60 minutes. With liquidity auctions, so those auctions that get triggered when there's not enough liquidity, it's a little bit more random. So it will have to be a quick T, I guess, or whatever. Because as soon as the market is balanced again, the market can become balanced in a sense of balancing between the liquidity supply and demand. So that could either happen because more liquidity providers join the market. They could do, because that is the moment where you can dictate the price to some extent, because it just needs more liquidity. So people were interested in that. So you could ask for a higher price. Also the market's value is usually lower at those points, so you could be getting a good deal, and that deal then stays with you for the duration of the market, because whenever we divide those fees, we look at your size of your commitment, but also the ratio of the market's value when you join to the current one. So if you sort of bought cheaply, let's say, the liquidity shares in the market, then you're always kind of better off. So there could be situations where you have a lower stake, a lower commitment than someone else, potentially much lower, but you're still making more money in fees than they do, because they joined when things were dandy and it was all sunshine and rainbows and it was quite easy, but you were there when the market was needed you. So it's all really quite romantic, I guess, if you want to think about it.
Only you can say that's romantic.
Romantic in a literature sense, not really like, I don't think people would be going on dates to love the Fairground. Would be cool if they did, but maybe not. Maybe it's better if they actually just go to a restaurant or whatever. Yeah, not everything has to be about Vega. Well, yeah, so that's what we do in those cases. I promised you that I'll talk about fees. I never did, so maybe let's quickly do it. It won't be long. So fees on Vega get paid on every trade. You don't incur any fees to post an order. You just need to have margin to to be able to do that. But if you cancel that order, then that margin makes its way back to you untouched. You've not lost anything. Fees are paid only when the trade is generated, and the party that pays the fees is what we call an aggressive party or a price taker. So it's this guy that posted the order that crossed the bid-ask spread, and it matched with something that was on the book. The guy that was already on the book, he doesn't pay anything. He actually makes a little bit of money because there's free fee components. The first, they don't have any cardinal ordering, but one of them is the maker fee. So that is the money that gets paid to the guy that was on the book. That is a little thank you because they also, supply liquidity. They are not a recognized liquidity provider because they didn't go through that transaction thing. They are not taking as much of a risk because they can pull out anytime they want. No one's holding any money. Like that stake, the commitment we have in this bond account. But they still do something useful, right? So it's good to reward them. The other fee component is the liquidity fee. So that again gets put into a bucket and distributed once per epoch. And the last component is the infrastructure fee. So that is the fee that then gets distributed amongst the validators and their delegators. That is because without those guys, you don't have a network. So, they are also doing something fairly useful. Liquidity fee gets, as we've talked at length about, determined by liquidity providers themselves. The maker fee and the infrastructure fee are governance-based. So, token holders vote them in. And again, it's the same principle as with liquidity providers. They could be greedy. I guess everyone is to some extent, but it's not always smart to be greedy because if they ask for huge fees, then no one uses Vega, and then there's no trade. So they, they thought they are going to make a killing. They actually barely, pay for their, servers or whatever. Or it was, the token value goes down, I guess, because it will be to some extent associated with, the traded amount because they basically entitle you to some portion of that. So as the valuation works, that there is a relationship between the two. So yeah, that's it on the fees.
So you referred to the aggressive. So if you look at the console, for example, for a normal trader, that will be the one that puts market buy, right? If you put a limit buy, you're not aggressive.
Not necessarily. You can only, if you put a market, you're always aggressive because you just, the market just tells you what you trade at and you trade at that. But limit order can also cross immediately. But you have a bit more control because it wouldn't go too far. With market order, you kind of don't know. You can have an idea because you can look at the, the chart, the market depth and stuff. But those things happen so quickly, we have 1 second block time. And so the structure of the order book could change between the time you observe it and your order actually makes it to the matching engine. So there could be some cases where you thought it's not too bad. And then you're like, oh shit, that was actually really expensive. So the market orders are for the adventurous types, I guess. The limit orders are, or if you're like really in a hurry. Let's not get into stupid metaphors, but if you're really in a hurry, the limit orders, they can still cross, but they wouldn't cross because the limit order tells that you're going to trade at the price you've specified or a price that is better for you, but never worse for you. The better worse, depends on which side the order is on. So you could still be aggressive even with a limit order. You can never be aggressive with a pegged order. Pegged orders are constructed in such a way that they never trade on entry, so they will always make you a little maker fee if they do trade eventually.
Okay, very, very interesting. Any more questions, Annie?
No, I think that's all from the chat. So thank you very much to both of you. And so we still have just under 24 hours left with the LP incentive. So keep submitting liquidity. We hope this helped. And all three of us will be available on Discord if you have any questions or queries or any follow-ups. But apart from that, thank you very much, gentlemen. And we'll see how the leaderboards stack up tomorrow.
Well, thank you for.
Can I have a quick closing remark?
Yeah, absolutely, with them.
Cool. I'm just very, grateful to anyone that's taking part in the incentive. Thanks so much for that. Please sort of be vocal about the experience. All those things I've talked about. We've spent a lot of time designing. We've convinced ourselves they make sense. They might even make sense. Who knows? I think they do. But sort of user experience, usability is also an important thing. So just because a few nerds locked themselves in a room for a year, it wasn't the same room, different rooms, but never mind. It doesn't mean you have to agree to it to some extent. Like, you can still be vocal about, this is really complicated, this is not intuitive, this is difficult, this is whatever. So please do, right? Because and no promises on how soon we're going to be able to accommodate those requests. But if we don't know, then we likely will never do that, because you heard me, like, I can talk about this forever and it all makes sense to me, but it doesn't mean it makes sense. In general, I've been toying with it in my head for so long that I definitely have some sort of a tunnel vision, right? And so just be vocal. Thank you for your time with playing with Fairground, and if you could spare just a little bit more of that time to just tell us about your experience. I guess especially if it's sort of subpar, it could be better, because that is how we can improve. If you think it's nice, maybe tell us as well, because we're only human, and it's nice to someone appreciate your work now and then, but just be vocal. Yeah.
And yeah,
Very good point.
Yeah, you can see how passionate Witold is about all this, and Witold, it clearly showed through in the chat, because someone in the chat while you were speaking said financial romance, lol. Yeah.
Well, it's late, yeah, so I say stupid things, but I'm glad people appreciate it.
Oh, lovely.
Perfect. Yeah, on that note, guys, thank you for watching the Fairground Jam, and we'll be on Discord tomorrow for any questions and queries and follow-ups. So thanks a lot, guys.
All right. Thanks so much, Sandy, for moderating. That was awesome, and thanks, Don, for your question. That made it easier for me, because I didn't have to prepare much. I just waffled a bit.